Yesterday's macroeconomic calendar was full of important releases. The Eurozone gross domestic product for the fourth quarter of last year met economics forecasts, and the market showed no reaction to this news. The British pound gained a bit, driven by statistics on UK unemployment and a rise in average earnings year on year. However, these reports took a back seat when the United States released data on inflation. The indicators were mainly in line with consensus estimates. However, the Consumer Price Index and the core CPI, excluding food and energy, decreased less than expected. As a result, this caused a surge in market volatility, followed by a rise in the dollar. U.S. consumer prices showed an annual gain of 6.4%, while economists predicted an increase of 6.2%. Core consumer prices gained 5.6% from a year ago against an estimate of 5.5%. Thus, the Federal Reserve will continue to counter rising inflation and keep interest rates elevated. Today is also going to be a busy day when it comes to macroeconomic indicators. The focus of market participants will be on data on U.S. retail sales. Analysts forecast retail sales surging 1.8% in January, following a decrease of 1.1% a month ago. All this will lead to stronger price pressures. Against this background, the greenback is expected to gain value, thus dragging the euro and the pound sterling further down. Traders may also take notice of UK inflation data. The monthly consumer price index is anticipated to climb by 0.4% in January. On an annual basis, the CPI is forecast to stand at 10.3% in January, down from 10.5% in December 2022. Nevertheless, the annual figure is expected to remain double-digit, which will force the Bank of England to continue raising interest rates. In addition, it is worth paying attention to statistics on industrial production in the euro area and ECB President Christine Lagarde's. And now let's move on to technical analysis. According to the 1-hour Euro-American dollar chart, a false breakout at the support level of 1.0714 following data from the euro area may create a buy signal. In this case, one can count on a recovery in the euro to 1.0766 and 1.0800. Short positions can be considered amid a false breakout at 1.0766 or on a rebound at 1.0800 and 1.0834 to catch an intraday correction of 30-35 pips. Alternatively, if the price breaks through 1.0714 and tests it from the bottom up, amid upbeat data on retail sales, the euro will dive to 1.0679. A false breakout at this level will make it possible to open long positions and earn about 25-30 pips. If the price overcomes 1.0679, it will most likely head towards 1.0645, the one-week low. At this mark, I recommend going long on a rebound, counting on a rise of 25-30 pips. As for the British pound, it may lose value if UK inflation shows signs of cooling. Therefore, long positions can be opened amid a false breakout at 1.2120 or 1.2079. If the consumer price index is above market expectations, the pound sterling will most likely rise to 1.1278. If the price consolidates above this level and tests it from the top down, a buy signal will be generated. In this case, the British pound will head for 1.2220 and 1.2265. At the level of 1.2265, it will be possible to go short on a rebound, counting on an intraday correction of 35-40 pips. Short positions at 1.2178 and 1.2220 can be considered only amid a false breakout. Going short will also be relevant after the price settles at 1.2120 following upbeat data on US retail sales. Thus, the bridge pound will slide to 1.2079 and 1.2033, where traders are recommended to go long to catch an intraday correction of 40-45 pips. Best of luck!